So, Mr. Faber, considering India's love for gold, would you advise investors to rather buy right now or wait out the volatility?
Well, I buy gold every month. I want to have approximately 25% of my assets in gold. I want to own assets that are not tied to the banking system, to the financial markets, because I think that all financial markets are very vulnerable. We haven't really solved the problems. We still have the derivatives outstanding. We haven't solved the debt problem. Total credit market debt everywhere keeps on rising, and that will lead eventually to a systemic crisis, to a sovereign debt crisis. Now, we don't know when it will happen, but I think I would watch the events in Detroit. Detroit in the 1920s was the richest city in the world, and now it is bankrupt. So it took a while to happen, but it happened.
Mr. Faber, fair enough. What about the other commodity out here? What are your thoughts when we talk about oil prices, and how do you see that actually panning out? Because that's the other key trigger to watch out for, both from India as well as the emerging market space.
I mean, I was in the Middle East 5 times between November 2012 and February 2013. And I tell you, I have a very bad impression of the developments in the Middle East and in North Africa, spreading into Central Africa. I think the whole Middle East will be in flames in a few years' time. And if that is the case, obviously, oil prices will be higher than they are now. Number 2, whereas in the US and Europe and Japan, oil demand is declining somewhat, not hugely, but declining somewhat. In countries like China and other emerging economies, the oil demand keeps on rising rapidly. In the meantime, the cost of finding a new barrel of oil, and this also applies to the mining industry, the cost of finding an ounce of copper or gold, the cost of finding a new barrel of oil is about $80. And so I rather think that oil prices will be supported and may surprise on the upside.